Hello and welcome to Options in Plain English. Today we're going to be talking about cover calls and we're going to be analyzing a cover calls risk profile. And this is the first strategy that we're going to be taking a look at where we are combining stock and options. So this is a very important strategy for you to know and to use because it's one of the most widely used as well. A cover call is made up of long stock and a short call. Usually the short call is established out of the money, but it could be also established in the money or at the money as well. It's important to notice that the quantities should match between the stock and the short call. So if you have 100 shares of stock, long stock, then you should be selling only one call contract. This strategy is bullish to neutral because what's happening here is that the stock is trading right here. We're selling this call at this point and we're giving up all of this area in terms of profit because the dotted line here, you can see this is the stock. So if you didn't sell the call, you'd be making a lot of money here. But instead of that, you are getting some premium in a similar way to what the insurance companies do. And because of this, you are giving up the profits from in this area in exchange for premium that you're going to get from selling this call. The loss can be substantial all the way down to zero. So a lot of people mistakenly believe that this is a very safe trade. In reality, this trade is completely exposed on the downside. So you're buying stock, you're selling a call, but if your stock starts going down, there's nothing preventing you from absorbing all these losses in here. So it's important to notice here that you're completely exposed on the downside. Once you have the stock, there is no extra BPR for the short call. It's only for the long stock because your cover is a cover position. There is no extra BPR, buying power reduction. This is what we were mentioning. You are giving up all the profits beyond the strike price in exchange for premium. However, once you hit your strike price, of course, you already have some profits. The only thing that you're doing is you're giving up the extra profits that would have come with holding the stock. This strategy is used a lot by fund managers because if the price doesn't move and if the price of a certain underlying of a certain stock doesn't appreciate, then this is a way to extract or to start getting some sort of a dividend out of their existing holdings. The risk, of course, is that if it does start appreciating, then the profits from that position are capped. So in exchange for that premium, they are giving up the profits that come with a large up move. But in exchange for that, also with that premium, you are protecting yourself a little bit to the downside. However, if there is a substantial violent move to the downside, then you're completely exposed other than the premium that you got. Another thing to notice is that the premium is higher when the implied volatility is high. Why is this? Because the price of the call that you're going to be getting, so the premium is going to be higher, is directly proportional to the level of implied volatility. So this strategy should be deployed ideally when there is an environment with high volatility. Now, some fund managers, what they do is they don't necessarily know all these details. All they know is that they make some money by selling calls, selling upside calls. And when the volatility is low, the premium is very low, and they're not being compensated proportionally to the risk that they're taking. In most platforms, a cover call is a single transaction. So you don't need to buy the stock and then sell the calls for this particular strategy to be in your account. You can do it directly through a single transaction where you select the call, the call that you want to sell, and automatically you're going to be selling the equivalent quantity for the stock that you need for your cover call. A cover call can be thought of as buying stock at a discount as well, because let's say, for example, we're gonna look at an example just now, but if you have a stock here and it's trading for $100 and you get $5 because of your call, because you're selling the call, then you're only paying $95 for a stock that's trading at $5. Of course, you are giving up any profit beyond your strike price, but it can be thought of a little bit as acquiring stock at a discount. Now let's analyze the price at expiration. What happens in the different areas? So as you can see here, the red area is the area where you're going to have losses, and the green area is the one where you're going to be profitable. Now there's a huge profitable area, but keep in mind that from this point and higher prices, your profits are capped. They're not growing with the underlying price. So just keep that in mind, because even though it looks as if it's a huge profitable area, in reality, you are going to have profits here, but they're capped. So when the stock price expires below the break even, you're going to have a loss. Your profit and loss at expiration is going to be the expiration price minus the initial price when you establish the position, plus the premium. You always get the premium. The premium you get to keep. If the stock price is right at the break even, then you're not going to have any profit or loss. If your stock price is between the break even and the strike price, so in this area, then you're going to have a profit which is going to be equal to the expiration price minus the initial price plus the premium. So in this area, your profits are going to start growing with the actual underlying price until you hit the strike price, because at that point you are committed to selling your stock. So the call buyer is going to be able to call your stock away. So when the stock price ends up at or above the strike price, then you're going to have a profit which is going to be equal to the strike price minus the initial price plus the premium. Now notice here, it's not the expiration price anymore. It is the strike price. So it doesn't matter how high it goes. You're only going to be making this money no matter how high it goes. This is what you're giving up in exchange for the premium that you get when you sell your call. Now finally, just as this is more of an advanced concept and something that you're going to be looking at when you start looking at put-call parity and some advanced concepts in terms of option trading. What you're going to see here is that a cover call is exactly the same and it behaves exactly the same as a short put. So those two positions are equivalent. They're synthetically the same. There's only minor differences when you think of a short put versus a cover call, but they're basically the same. Another thing that I didn't have here but that is important is when you have a cover call, because you have long stock, if there is a dividend in between, then you're going to be receiving the dividend. So which is something that's different than if you had a short put. So as part of the analysis of a cover call, you have to consider if there's any dividend, because if you're a long stock, and it doesn't matter that you have a short call, if it's not exercised and you are on the ex-dividend date, then you're going to receive that dividend. So that could be an additional source of income for those positions, and that is the reason why many fund managers choose to use this strategy, because not only do you get a premium, but you also get dividends if there are any. Now let's take a look at an example of a cover call. So we're going to take a look at all the different details and the mechanics of a cover call. So here we have the actual position, the cover call, and what we have is the structure is long 100 shares of the underlying at the money, so you buy them the price they're trading at, and short one call contract at the strike price, KC in this case. I called it KC. Okay, the break even is going to be where the stock is, which is the at the money, minus whatever you got for the call. So minus the premium that you received for the call, ATM minus C. This is going to be the break even. The max loss is going to be the same as the break even, because once you get here, there is nothing stopping you from losing money if the stock starts going down, and it could potentially and theoretically hit zero. So the max loss is the stock price, or the at the money, minus the amount that you got for the call, the premium. The max profit would be the strike price that you have here minus the price of the stock when you initiated it, which is the at the money, plus the premium that you got for the call. So basically, the max profit is this distance that you can grow in terms of price and capture the profits, plus the premium that you got from the beginning when you put the position on. Okay, so that's gonna be your max profit. The call strike minus the initial price of the underlying plus the premium that you got for the call. And this is a representation of the profit at expiration, the profit at a time prior to expiration, and this dotted line, it's representing the stock. This is what the stock would make if you were long the stock. Okay, so now let's take a look at an example. We have a stock at $70, so it's trading at $70, and you're gonna buy the stock and at $70 and simultaneously sell the $80 call for $4. So the $80 call, that's gonna be your strike price for $4. That's gonna be your premium. It's gonna be a single transaction. You're gonna have the $80 cover call for $66. So basically what you're going to be doing is you're going to be buying the stock at a discount, because you're going to pay the $70, but you're going to receive simultaneously the $4 you got that you're going to get for the premium. So your actual price is going to be $66. And again, most platforms handle this as a single transaction, but you could also leg into this. But if you are going to initiate this particular position, then you can do it in a single transaction, and you're gonna get a better bid ask. So you're gonna get a better execution for this. The break even is $66 because you are here and then you receive this premium. So this is protecting you on the way down. And after you hit the break even, anything beyond that on the downside, you're going to be losing money. Okay, break even is 66. The max profit is going to be $14. So the strike minus the at the money, so 80 minus 70, so 10 plus $4 for the premium, so $14. When you're here, you're making 4, and then you start growing at expiration. If you end up here, then you're gonna have, for example, $5 and $4, $9, all the way until you hit 14. At that point, it doesn't matter whether you go higher or not, because that's going to be your profit, because at this point, when it expires, you're going to have your short call assigned. Someone's going to exercise it. So the other side of this transaction, the buyer, is going to exercise it because it's going to end up in the money. And then you're going to lose your stock. And you're going to be selling it at $80. And because you already got $4, you got 80 minus 70 equals 10, and then $14. That's the max profit. Max profit is 14, and the max loss is $66 if the stock goes to zero. Again, there's nothing here protecting you. So if it starts going down, it can go down all the way to zero. So Again, many traders think that this is a very safe, very simple strategy, although it is simple and it is somewhat safe in a bull market. If there's a situation where you have buy and move to the downside, then you're going to start losing money. So there's nothing options wise protecting you from sustaining a pretty heavy loss. So that's important to understand, because this is a misconception about the cover call. Max loss is 66. Now, let's analyze and let's see what the conclusion is about this strategy. You are giving up all the profit beyond 80. So the max profit is $14 per contract. So if you had only the long stock and it goes to this point, let's say it goes to 200, then you make the difference between the final price and the initial price. So you would make $130. In this case, because you gave up all the profits beyond this point, you're only going to be profiting by $14. So that's a big difference. You are not going to have the home runs. You're not going to, you're basically, to use a colloquial term, so you sold your soul to the devil. So you already gave up on all the profits beyond that point, probably because you didn't think that it was going to reach that point, or if you're a fund manager and you're okay with that profit, so you're saying, okay, if it goes to 80, I'm okay with it, and that's what I wanted, and on top of that, I'm going to get a certain premium, then this is an excellent position to have, because you're being paid to wait. The exposure on the downside is substantial. It's all the way to zero. Early exercise is possible, but unlikely because of extrinsic value. So when you have this call and it's a certain time, it's a certain point in time prior to expiration, though this particular call is going to have some extrinsic value. If the buyer exercises, then he or she is she's foregoing all the remaining extrinsic value. So this is the reason why early exercise is usually not something that happens very often. As expiration approaches, the extrinsic value starts going down, and then the possibility or the probability of early exercise starts going higher, until if you hit expiration and you're in the money, so extrinsic value goes down to zero or very close to zero, then after expiration you're going to be exercised for sure if you are in the money. And if you expire in the money, then your stock is going to be called away, because remember, the long call gives the buyer the right, but not the obligation, to buy stock at this price. So if it ended up over here, then it makes sense for he or she to buy at this price. And because you already have the stock, you're going to be selling it at that price. Something I already mentioned, you will receive dividends because you are long stock. So if it doesn't matter that you have a short call here covering your long stock, you will receive those dividends. So that's a source of that's part of the income. That's going to be part of the income stream for this particular position. And this, as we were saying, a cover call is the same thing as a short put minus the dividends, because when you are the short put, you're not long stock. The only situation where you receive dividends is if you're long the stock. So the same position as being short, this is the same position as being short the $80 put for $14 is the exact same position, but you're not going to be receiving the dividends. So that's the only difference. But the a cover call is the same position as a short put, and we're going to see why later on when we talk about put call parity and synthetically equivalent positions. But for right now, it's suffice it to say that a short put is the same thing as a cover call. Now we're going to come here to the platform and we're going to take a look at American Express, which is AXP ticker symbol. And what we're going to be doing is American Express is currently trading at $86. And what we're going to do is we're going to do a cover call. And so you can see this is Thinkorswim, but most options, especially the ones that are geared toward option traders, you're going to have something similar where you're going to see that I'm going to do this as a single transaction. So it's trading at $86. I'm going to open up the June expiration, 39 days to expiration. And if I look at the calls that are available, I have the it's trading at 86. I'm going to look at the $90 call, which is a delta, 41 deltas. So I'm going to be selling, I'm going to be buying 100 shares of AXP, American Express, and simultaneously I'm going to be selling the $90 call. Okay, for that I'm going to be I'm going to be getting $3.45. So the stock is going to be actually cheaper for me because I'm going to be giving up anything in excess of $90, any profits in excess of $90. So what I do here is something that's very simple. I come here, and then in the case of Thinkorswim, I go buy and then cover stock. And here you have it. So you're buying, this is called covered. You're buying 100 shares of American Express, and then you're selling one contract of American Express, $90 call for June 2020. So the whole transaction, instead of seeing this as a credit and then the debit for the acquisition of the stock, instead of that, what you're going to see is that you're going to see the purchase price for that stock to be lower by the amount that we're selling this call for. So I'm going to be buying it for $82.79, $82.80. It's right now fluctuating because we're in market hours. So you can see that it's I'm going to get it for $82 instead of $86. So this is where the credit that I got for the call is making that price be cheaper. So if I go here, if I go confirm and send, you're going to see that this is my break-even stock price because this is what we saw. The current price minus the premium that I got. The max profit, you need to consider the amount that you can get all the way to 90 and then add the premium that you got. The max loss all the way to zero. So $82.79, $8,279, not including the dividend risk. So two things: when you can be exercised early because of dividends, when you have a stock, and also when you are exercised, you're going to lose your stock and you're not going to get the dividend. So that is called dividend risk. The cost of the trade. And the buying power effect is because I'm only being margined on the long stock. So this is about 50% of the whole price. So I don't need to be margined on the short call. Remember that it was 20% of the full price. So I'm not going to be margined in addition to this because my position is being covered by the stock. Okay. So what I'm going to do is I'm going to send this. And it got executed right away. Okay, now we're going to go to our monitor page. It's right here. So now this is my position. I have 100 shares of American Express at a trade price of $85.87, and then I'm short one contract of the 90 June 2020 90 call with 39 days to go. And the trade price was $3.20, right? So the whole position, when I look at this whole position, I have to look at both components. So anything that if the stock starts making money, then probably the short stock, the short call, is going to be losing money. But altogether, you're going to have to take a look and see whether you are making money on your whole position. You have to take a look at, now that we started looking at strategies that are combinations of options and stock, either long stock and short stock, and with long calls and short calls and long puts and short puts. Now you have to, when you look at a certain position or a certain strategy, you have to consider all the different components or legs of that strategy. In this case, if you analyze the number of deltas in your exposure to your directional exposure, you're going to see that you're going to get 100 deltas because of the stock. That's 100 all the time. For every 100 shares, you have 100 deltas. And then you sold the approximately the 40 delta call. So you have 40 negative deltas. So because it's the same underlying, you can just add them up and you have your full exposure for that particular position or for that particular strategy, which is 60 positive deltas. Now, 60 positive deltas is a bullish strategy regardless of the fact that you are selling a call. So it's important to understand that a cover call is a bullish strategy, but it's considered a bullish to neutral strategy because you don't think that it's going to be going too much higher. Otherwise, you would have stuck with the stock. So because of this is considered a bullish to neutral strategy. So you just add up the deltas for the individual components because it's the same underlying. You can't do that across underlyings, but for the same underlying, you can just add them up. Now, quickly, we're going to go to analyze and American Express right here. And this is the position that we have. Okay. 100 shares of stock and one short call. And this is something similar to what we were looking at. Okay. So anything that is above $90, you have a profit, see the blue line, but it doesn't go any higher than that. Okay. If you were to take off the option portion, you would see is pretty much stock. Now you don't have an expiration because you don't have an option portion, and you can see that you keep making money all the way up. Once you add the option, now you are capping your profits at any point beyond this strike price. Okay. Now you can see this is the purple line is the line for today. So this, of course, this strategy takes some time to develop, and this line is going to be moving over time. So this is what I'm going to do. I'm going to start moving the time. I'm going to simulate time passing, and you're going to see that let's move the expiration date here to the 20th of June. Okay. So now I'm going to simulate time passing. You can see that the purple line is starting to approach and starting to merge with the expiration line. And this is the effect of theta. This position is theta positive. Okay. So you are making money with each passing day if everything else stays the same. So this is a premium selling strategy. So where theta works in your favor instead of something like a long call where theta works against you, because every day passing, you're going to start, because of time decay, you're going to start bleeding value. In this case, theta is something that's good for you because look at the purple line. With every day, you are making money. It starts going higher until at expiration. It merges with the same line, and this is your profit and loss at expiration. So this is how a cover call works. I hope that this was interesting and that this can help you improve your trading. And hopefully, with all these strategies that we've started to take a look at, you can start building your arsenal and your all your different tools to start putting on your positions and being a better option trader overall. Thank you very much for your attention, and goodbye.